Hey guys, welcome to the first video in the Elevate trading course. So we're going to be discussing what is structure and how we can map it. So structure is the most important tool in our arsenal when it comes to identifying which direction we're going to be trading in and which direction the market is moving, so we can decide whether we're pro or counter trend. So here we have an example of a bullish market and a bearish market. So a bullish market is a series of higher highs, higher lows. And as you can see, we're trending upwards here, creating higher highs, higher lows, on and on. So that's a bullish trending market, and vice versa for a bearish trending market. We can see lower lows, lower highs, lower lows, lower highs. And we keep putting these in until we break the lower high, which then switches to become a higher high and then back into a bullish market. Okay, so what these levels are here are swing points. So if we use a tool here, we can map on the swing points like so, and same for the bearish market. And each lower high, lower low is a swing point. So in order to see a break of structure, we need to see a break of this swing point each time. So there's no break of structure if we just break some internal structure here. It has to break the higher high or the higher low or the lower low or the lower high. So for example, breaking this would be a break of structure, and so on. Okay, so a break of structure, if we just get a wick below this lower low here, that isn't a break of structure. So if it wicks below and then pulls back, it needs to close with a candle body. So for example, if we're on the 4-hour time frame and we get a candle, we get a wick below this, that would just be a sweep. There needs to be a candle close, and it's the same for any time frame. And a swing point, so for example, we have this lower high here. If this lower high then messes around like this and fails to put in a lower low, this lower high isn't actually a lower high until we break this swing point here. Because for example, price could just come up and do this, so our swing point wouldn't be this, it would be this one here. So let's move on to a more complex example where we can identify this happening. So for example, here we have a bullish trending market. We can see we're making higher highs and higher lows. So we've got a higher high here. Okay, and we're making higher highs, and we're going to put on our swing points here so we can identify where those are. Okay, so price comes up and it creates this higher high via a pullback. So this pullback here is what creates this higher high. Price then comes down and you can see we have these two lows created, and then we come and break this high here. So we've got our break of structure. Okay, so now we have to pick a swing point for the low, for the higher low. So we can mark on the lowest point before the break. So it wouldn't be this one because there's a lower point than that, which is this. So whichever is the lowest point, even if it's a wick or anything, it's always the lowest point before the breakup, which then puts in the higher high and confirms this higher low. And it's the same again, so we come down here, create a higher high through the pullback. We then push up, come down, and then we get our break of structure, breaking this higher high. So we can mark on our swing point, and then we choose a low. It's this one here, and we can drag this over. Okay, so then we've had a break of structure, created a higher high, pull back into here, and then we have another break of structure here. And it's the same thing over and over again until we break this higher low. And it's always the most recent higher low that's created that needs to be broken. So if price only came into here, we wouldn't have this higher low. We'd just have, we wouldn't have any break here. So we could equally run down, running this level here and trending down. So in that case, we'd have a break of structure from this higher low. So this would be the swing point that needed to be broken. Because we've pushed up here, this is the current leg of structure. So even though we've created this low here, until this higher low breaks, there's no break of structure here. So even if it broke down here, it needs to break this higher low, this previous higher low. Okay, so if we move on to the bearish market, same thing applies. So we come down, pull back, and then break down. So in this situation, you can see the pullback here is quite small. So we have rules around that. So our rules are, on the daily, we need to see a pullback of 100 pips at least for this leg to be classed as structure. 4 hour 40 pips and 15 minute 13 pips, and it must be more than one candle. If you see a pullback that's just one candle and then it breaks down, for me that's not structure. It needs to be at least 2 candles, and ideally it needs to be at least these number of pips. So I wouldn't class this as structure. What I'd do is I'd mark the new low that's created from the bigger pullback. So this would be my swing point here. So this would be our lower low. Okay, then we pull back up into here, and then we have a break of structure breaking this lower low. So we mark on the swing point, and then we have the high that broke this low, and that is our lower high. Okay, and then come here, pull back, so creating a lower low, and we pull back into here, and then we have a break of structure again, and we mark on our swing point again, which is the highest point before the break. We then have a lower high confirmed, and finally another break of structure, which creates a lower low. I'll keep doing that, and then we confirm this once this breaks with a lower high, which we can mark our swing points on. Got that one. So yeah, it's the same thing over and over again. Pull back, break, and then lower high, lower low. So yeah, we're going to move on to the next video, and it's going to be application and applying this to the markets, and developing a better understanding in a live market.